Welcome to seventh lecture on basic macroeconomics. Today our topic is macroeconomic analysis, sectors and variables. It is actually part two. In part one we discussed about sectors, and in today's lecture we'll be focusing on variables. So let's move ahead with the subject. Now you need to keep in mind one very important thing about economics, and it is that economics is about relationship between different different economic variables. Yes, it is a very important thing that we need to keep in mind. So you have different variables, for example variable 1, and you have then variable 2. Now they have some relationship with each other, and it is these relationships that we are looking for, we are analyzing, and we are focusing upon in economics. So it is really very important therefore that we have to focus on variables. And for example, let's take some examples. If you have studied microeconomics, in microeconomics you studied the relationship between price of a commodity, price of X, and then the quantity demanded of X, or price of X and quantity supplied of X, or then uh, output of X and the costs of X, so on and so forth in microeconomics. Similarly, in macroeconomics, you will be focusing on the amount of labor and then output produced by the labor, and you will be focusing upon, for example, in investment and its relationship with interest, or exports and their relationship with output, the national output. So we are dealing everywhere with relationships, and the theories and models that you study, all of them involve relationships, the relationship between different variables. So we need to therefore focus on macroeconomic variables. Now, how are macroeconomic variables now different than microeconomic variables? So we are dealing here with macro variables actually, and we know that macroeconomics is about aggregate economics. Therefore, variables are concerned with the aggregate of economy. Those economic variables which deal with the aggregate economy are called macroeconomic variables. So they deal with aggregate economy or collective economy. Now, two things you need to keep in mind. One thing is that they are uh, aggregate variables, economic variables, and the second thing is that they have got there is they are interrelated, or they are interdependent. Therefore, it becomes important for us to understand and relate these variables. Now, we can say there are two types of variables when we are in the domain of macroeconomics. These are two types, we can say. One is the sorry goods market macro variables, and the second type is money market money market macro variables. Now you can notice this thing that this was not involved in microeconomics, because money is a macro subject. Directly we don't study money in microeconomics. Therefore it gets involved over here. uh, an economy has got two dimensions. One is that of goods and services, and another one is that of money. Now, money itself is having a market. It can at times be treated as a commodity, and then we have goods and services. Therefore, all the variables can be related or put into different domains: the goods market variables and the money market variables. Now, let's first focus on the goods market macro variables. Okay, macro variables. Now, take the case of GDP. It's a goods market macro variable. Similarly, you can take consumption expenditure. It's a goods market macro variable. Saving, then investment, then we have revenue, government revenue, and then government expenditures. These are goods market related. Then we have exports and imports for an economy. All these are goods market. No, these are goods market macro variables, and over here these emerge from actually the goods market itself. Now, when it comes to the money market macro variables, examples include money supply. Similarly, we have money demand. We have, for example, rate of interest. We have exchange rate. Then we have balance of payments and foreign exchange. All these are actually part of the money market. Therefore, they will be called as money market macro variables. So this is one way to make a distinction between the different types of macroeconomic variables. Now let's move to one further distinction which is more important at the elementary level when we are studying economics at your level. So variables can be categorized into two types. One is the flow variables flow variables, and another one is stock variables. So we have stock variables, we have flow variables, and the flow variables are measured over a period of time, over a period, and these are measured at a particular point in time, in time, at time. Okay, period of time, over a period of time. Sorry. Okay, fine. Now let me give an example over here. Take the case of sales for a businessman. If you ask a businessman how much sales do you make, he may tell you that he makes sales of, for example, 200,000 per month. So his sales are 200,000 per month. Similarly, if you tell somebody what is your income, he may tell you, I have got, for example, 100,000 rupees per month. It may be somebody's income, for example. So these are examples of flow variables. On the contrary, now take the case of inventory. What is inventory? Inventory. It is a stock. It is stock with a business person. Business with a business person. Okay, business person or a business. That is the goods that are commodities that lie in the showroom or in his go down or in his shop. Okay, so that is what we call as inventory, or sometimes we call it stock. And if you tell somebody how much stock do you have of a particular commodity, he may tell you, I have got 100 units. 100 units. So he is telling you at this point I have got 100 units at this point. Or he could tell you that before on 30th, for example, on 29th of January I had 200 units. 200 units. So he will not tell you that it is 100 units per month or 200 units per month, because this is not how we measure stocks. Stocks are measured actually at a particular point in time, at a particular point in time. Similarly, if you tell somebody what is your wealth status, how much wealth do you have, he may tell you that I have got 2 crore rupees, 2 crore, for example, dollars, or 2 million, $3 million, whatever. So what he is telling you that is that at a particular point, or at that time you are asking him particular point, at that time you are asking him the question, at that time he has 200 crores. He won't tell you that I have got 2 crore per month wealth, because that is not how wealth is measured. Wealth is measured at a particular point of time. So we have two different types of concepts about this. We have got two different types of concepts about variables, types of variables. One is the flow variables and the second is stock variables, and we try to make this distinction clear through these examples. Now let us take some examples of macro stock variables, which you will be encountering in your books now. Stock variables. So one example is business inventory. Business inventory. Okay, one example, business inventory, as we talked about it, the stock that remains in somebody's shop or go down. Then we have stock of money. It is also a stock concept. Sorry, yes, supply of money. Similarly, we have capital, the amount of machinery available in a particular economy or a firm at a particular point of time. So that is capital. Similarly, we have labor force. It is a stock concept, labor force, okay, at a particular point of time. We have employment. What is the level of employment right now? So you get it at a particular point of time. Or wealth, as we have already discussed. So all these variables are stock variables. Okay, so let's move to the flow variables. So let's focus on flow variables now. Macro flow variables. So the examples include GDP or output. Now obviously this is measured normally per year of time. Okay, so you can take the example of income of a person, for example, income of a person or an economy later on. Income of a person, for example, let income of a person be 100,000. Okay, so income, it will be per year 100,000 or per month. Then consumption. Now let's suppose that the person is spending 60,000 on consumption, and then he is saving 40,000 from his total 100,000. So consumption is how much? It is 60,000. It will be per year, and then saving will be equal to 40,000 per year. Okay, so these become, therefore, consumption and saving become, therefore, flow variables. Similarly, we have exports and imports. Okay, they are measured again per year. Then we have government revenue and expenditures. Again, they are also measured per year. Over a period of 1 year, for a period of 1 year they are measured. So these are therefore also the flow variables. So I hope that we have made this distinction clear, the difference between stock variables and the flow variables. Do subscribe to my YouTube channel, Macroeconomics. Thank you very much.